Thank you for attending Low Load Insurance's webinar on long-term care and life annuities. The hybrids are here. As you can see, Low Load has introduced their own special limited edition Prius. Just kidding. Hybrids are vehicles that use both electricity and gas. Hybrid insurance products like the Prius have been around for a long time, but they have been revamped and renewed to be more of what the consumer is looking for. Hybrid cars combine gas and electricity for efficiency. The hybrids we are going to talk about today combine life and long-term care insurance and annuities and long-term care insurance. And when you consider that 49% of people turning 65 will need long-term care insurance at some point in their lives, and national average for a one-year stay in a nursing home is $71,000. How are clients going to pay for this cost? They have 5 ways that they can fund long-term care. 1, they can self-fund. They can pay for the long-term care needs that they're going to have out of their own pocket, out of assets that they've accumulated, or they can self-fund and buy a basic short-term benefit period long-term care insurance policy. So they have assets that they feel they can pay for part of their long-term care, but they want a policy to pay part of it for a short period of time. Or they can also self-fund and buy long-term care insurance with a long elimination period, meaning they feel they've got assets to pay for that long-term care insurance up front, but if their stay or need for long-term care is extended for a long period of time, they feel they will need some insurance to help pay for that cost. They can buy long-term care insurance to cover most or all of their costs, and this is more where middle America would be. Or they can buy life insurance policy that allows prepayment of the death benefit if they need long-term care insurance. Now, throughout this webinar, we're going to refer to these products as hybrid products, but you may also hear them referred to as other products. They're referred to as ABC products or asset-based care, or they're also referred to as linked benefit products. All 3 of these terms all mean the exact same type of product, but for purposes of this webinar, we're going to refer to them as hybrid products. Hybrid annuities in life. What is really great about them is with the same amount of money or that same premium, these products can do double duty. They can provide either annuity benefits, whereas they can get income in retirement that account value can pass to beneficiaries, or if they should need long-term care in the future, these products have a long-term care feature that can pay for part of that cost. But more importantly, these products answer the #1 objection to long-term care insurance. Why should I pay for something that I may never use? When you look at the cost for a traditional long-term care policy, those premiums can range anywhere from $1,500 on up to $7,000 or more per year. And a lot of clients feel that that's a lot of money to pay for insurance that they may never need. So what made these products possible or clarified it was the Pension Protection Act of 2006. What are some common misconceptions about the PPA? #1 thing we get asked about is, can my client withdraw money out of their annuity to pay for long-term care insurance? And the answer is no. They cannot withdraw money out of a life insurance product or an annuity to pay for long-term care insurance. Also, no qualified funds can be put into these hybrid products. These are 2 of the most common questions we get asked. So what options did the PPA create? Here are 2 non-hybrid options. Clients can use a traditional single premium immediate annuity to fund long-term care insurance, and they can use a traditional single premium deferred annuity to fund long-term care insurance. Traditional single premium immediate annuities to pay long-term care insurance before January 1st, the way it worked is that income out of an immediate annuity was a return of part gain and part return of premium. The part that was returned as gain was taxable. So many of you may know is that there's an exclusion ratio with an immediate annuity. And what that exclusion ratio does is that tells you what part is return of gain, what part is return of principal. The part that is gain is taxable to the client. But after the first of this year, what has changed, or what was clarified by the PPA, is that income assigned to pay long-term care insurance premiums is tax-free on otherwise taxable part of a payout from that immediate annuity. So where we had an exclusion ratio with the traditional SPIA product, with the new law that was clarified, any income out of an immediate annuity that is used to pay long-term care insurance is tax-free. There is no exclusion ratio. And what this does is this gives you a higher net payment that is available out of that immediate annuity to pay for long-term care insurance. But the problem is the tracking and reporting of this. Not many companies are able to do this. And if they're doing this before age 59 and a half, they could be subject to the 59 and a half, the penalties. Now let's take a look at an